CFDs at a glance. CFDs allow investors to benefit from the capital gains from a particular stock without them having to actually physically own or pay for it. 2. CFDs allow you to participate in the stock market at a considerably less cost than via traditional share dealing. This is so because CFDs only require a small initial margin as a trading deposit. 3. You enter into an agreement with a CFD provider, usually a stockbroker or a firm offering an online dealing service, to settle the difference between the price of a particular investment when the agreement is made and its price when the agreement is ended. How profits and losses are calculated. 1. The profit or loss you make is determined by the difference between the prices at which you buy and sell the contract. 2. You have an interest in the movement of the share's price, but do not buy or hold the actual shares itself. In fact, the broker is able to hold the shares. This provides an offset against the contract. 3. The investor using CFDs has one key decision to make. Do you think the underlying investment is going up or down? Get it right and you win. Get it wrong and you lose. 4. Contracts for difference allow you to sell shares that you don't own. This enables you to profit from falling share prices. 5. As with spread betting, the amount you lose can be limited with a stop loss. How is interest charged or credited? Interest is calculated and charged on a daily basis on the contract value. However, for a short contract for difference position, a conventional share sale is simulated, so interest calculated on a daily basis will be earned rather than paid. The rate is usually calculated at a margin rate above for long CFDs or below for short CFDs. The Reserve Bank's interbank overnight cash rate plus or minus 2 to 3%. For instance, the interest rate applicable for overnight long positions may be 6% or 0.06. To calculate how much it would cost you to hold a long position for X number of days, you would need to make this pro rata, meaning that you would need to divide the 0.06 by 365 and multiply it by X days, and then multiply this by the trade size. So for example, for a trade of $20,000 held for 30 days, the interest cost would be $98.60. For more information, visit www.contracts-for-difference.com.